Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Peterson.
Thank you for joining us. This is the Real Estate Risk Report. I am your host, as always, Lance Peterson, although today I do come to you from a new location. I am in Kingwood, Texas, just outside of Houston, Texas. My family and I made the move from Portland, Oregon, a couple weeks ago, so this is the first episode we'll be recording. Super excited to have today's guest on with us. He was referred to me by someone else in our network. Really glad to have had the chance to meet him here, and we'll pick his brain. His name is Alan Rosca. He is based in Cleveland, Ohio, and he works with a firm called Goldman Scarlato, and they represent victims of Ponzi schemes of all sorts. So I'll let him sort of share more about himself and what the firm does and how they do what they do. But we'll definitely get into it. As most of you are well aware, at Verivest, we're really passionate about a sort of helping investors know who they're dealing with before they deal with them, and knowing that after they decide to deal with them, that their money is going where all the money's going where it should be going, and that the assets and the things they've invested in are actually real and not made up. So, on one hand, we try to prevent it. On the other hand, for those that slip through the cracks, Alan and his team are out there to sort of, help clean up the mess and get back what was lost. So, Alan, why don't you share a bit with us about your background, how you decided to, you're an attorney by trade, obviously, how you kind of got into this, and how did you land at this firm doing this very specific thing?
Thanks, Lance. In terms of my background, before law school, I used to work in the financial industry. So I sort of acquired the insider view, compliance, due diligence, things that an investment professional looks at when vetting an investment product, or looking at a company that's issuing shares or other securities to investors. I started representing investors in 2008. My main focus is on victims of Ponzi schemes and other types of investment fraud. I've also taught as an adjunct securities regulation at one of the law schools here in town, and I very much enjoy doing it. I've been working with my current law firm, where I'm a partner, since 2018, as my practice has shifted a bit more towards class action work. Right now, I do about half of my cases are arbitrations on behalf of individual investors, and the other half are class action cases, again, chiefly on behalf of investors against typically problematic investment programs, and entities that might assist in fraud or Ponzi schemes.
Yeah. Oh, very good. Yeah, it's good to know. Yeah. So there's those that where an investor feels they've been wronged, a specific investor comes to you, says, hey, I think these guys are doing some shady stuff. Right. Let's go rattle their cage and let's get me out of this thing before there's too much damage. And then there's those who, the whole thing kind of blows apart, and now they need someone, form a class action to kind of go and attempt to recover whatever can be, recovered. Is that accurate?
Like you put it, clean up the mess, or try to
clean up the mess. Yeah, figure out what's there and figure out how to get what's rightfully owed to the investors. So
right.
One of the things that I've always thought about with this is that, and maybe I'm wrong with you, so I'm curious to get your sort of take on it. Right, is around that notion, is that it seems like a lot of times you will have maybe a more sophisticated or astute investor in one of these partnerships or something that does sort of, canary in the coal mine, kind of notices before the others, right? And goes and gets an attorney like yourself. And maybe it's not, clear cut, full blown, Bernie Madoff, type of thing. But where they do end up kind of, suing them, civil lawsuit, right?
Right.
And then they get out of the thing. But then as part of the agreement, it seems like some of that stuff sort of like, well, yeah, we agree to, I'm going to give you your money back, but you can't go and make a big deal about it. So therefore, like maybe there's some victims left behind, or am I just being a bit paranoid?
Well, it's oftentimes tricky to do this when you have an investor who figures out that the investment product is problematic, or investment program. It very much depends what's wrong with that investment program. If it's a company that's a legit company that indeed has a business but violated the securities rules and regulations in the way they raised money, then this approach of one investor hiring a lawyer and then going to the company and saying, you pay me back or I'll go public. This approach might work. And again, we're talking generalities now, so it's case specific. On the other hand, if you have a Ponzi scheme situation where, say, one investor figures out that the investment company is not a company but a fraud, right? Yeah. And the hallmark of a Ponzi scheme is you use new investor money to pay existing investors. Well, if that person goes to the company and says, I figured out this is a fraud, not just a fraud, a Ponzi scheme.
Yeah.
Give me my original investment or I'll go public. It's not that easy, because that person implicitly, if he knows that this is a Ponzi scheme, or she knows, it means that they also know that any money they get back from the scheme, it's likely money that belonged to another investor.
Yep.
So in other words, the money they're receiving is in a sense dirty money.
Yeah.
And what's going to happen is, if that scheme blows up at some point soon and the court appoints a liquidator, a receiver, or a trustee, that receiver or trustee is going to go back to this investor and say, hey, the money that you got back, you knew was not the company's money, but likely money from some other investor, because you figured out that this was a Ponzi scheme.
Yeah.
So you knowingly received money from some other investor, right? That was given to the company to be invested, not paid to you in settlement.
Yeah.
So you have to give it back. And that's called the clawback procedure.
Yeah.
So even extricating yourself from a Ponzi scheme, once you become aware it's a Ponzi scheme, is trickier than it might, seem at first sight.
Yeah. And is really your first line of defense then is going to the SEC? I mean, is that kind of what, okay, I'm in a Ponzi scheme. We need to notify the regulators, and then they need to begin, because at that point, you're kind of like a whistleblower.
Well, and again, it depends from case to case, but that's definitely something that we look very closely at. And so I have whistleblower cases where, you look at the program and it looks like a fraud, and the approach is to let the SEC know. There's a program that includes an award for those whistleblowers who will blow the whistle, I guess, to the SEC, and then they can get up to 30% of the money that the SEC recovers, over $1 million.
And I have read recently too, with some of that, it gets a little tricky as well. The whole thing's very tricky, but is that sometimes when the SEC sort of says, and it becomes like a different criminal proceeding or whatever, then the whistleblower awards are sort of, not in play any longer. Is that accurate?
Well, it's a minefield. It depends who else gets in the case, how the scheme ends. Is it a bankruptcy or some other type of liquidation? There could be other regulators who step in and they might take over the case. Sometimes a scheme might fall both under the Securities and Exchange Commission's jurisdiction, as well as under the Commodities Trading and Futures Commission, CFTC's jurisdiction. And so you might have, plus maybe state regulators, state securities regulators. And so depending on this interplay, that might dictate what could be recovered at the back end by whistleblower.
Yeah. So for you and all the cases that you've seen and in your experience, I mean, roughly, like, what percentage of these were sort of like just blatant like frauds, like literally, I'm going to do this. The whole thing from the get-go is a Ponzi scheme versus those that were, because I call it the slippery slope. Because everyone, to me, they think that I'm like, Lance, you think that all this stuff is like, I'm like, I don't think that's all Bernie Madoff, like woke up and we're just going to like, this is what we're going to do. We're just going to be really bad guys and do this. I think it's like, it seems to me, it's more of the magnitude is usually much more subtle than that. And it's sort of they cross the line at some point. So maybe I'm wrong, but what do you see?
Lance, you hit the nail on the head with that. And the fact is that even with Bernie Madoff, there's when he testified during his guilty plea in late 2008 or early 2009, he said something that stuck with me. And he said, I made some promises I couldn't keep. Yeah. And instead of coming clean, he started, taking other investors' money to make good on those promises. And that's when his program became a scheme. So in a sense, even Bernie Madoff was not a Bernie Madoff at the beginning, so to speak. The point being exactly what you just said, which is that in my experience, very few people, maybe not very few, but few people start out as fraudsters from the very beginning. I see cases like this where somebody from the very beginning, they designed something that they know doesn't work and it's just smoke and mirrors. And they put together a pitch that they market that they know is fraudulent. But that's a tiny minority. What typically happens is exactly what you said, which is the slippery slope. Somebody starts with a plan that's, there's usually a flaw in their business model and it just doesn't work. And it takes them maybe a few months or a few years to figure out that it doesn't work. Other times the business model works at the beginning, but then something changes in the marketplace. Interest rates or some paradigm shift, some Amazon disruptor, right, comes along and disrupts the industry. So something might change and that renders their plan flawed. Or again, there might be a flaw in the plan to begin with, in the business plan. But whatever the reason, they might start legit. And then as time goes, just like Bernie Madoff said, they make promises they can't keep, and instead of coming clean and saying, hey, I promised you 12%, but I can only deliver 6%, and here's why. The business might shut down, investors might pull their money out, but nobody's going to go to prison.
Yeah. And do you, like from, having worked on many of these, I mean, what are the things that you think that people can do, or what are the things that you've seen that people weren't doing that had they done them, they could have sort of identified it, more quickly? Or is there some other hallmark of, I mean, for me, of course, I go straight to it's the opaqueness, that there's just, it's a black box they can't see inside of, but but that's my own bias coming out, because that's how I look at the world is, right. But maybe, what do you see? Or are some of these guys just really, really, really clever, and they're really, really good at sort of hoodwinking people with like forged documents, and, are they really going to I'm always curious as to what inside some of these cases it really looks like, or are they just somehow it just was really the lack of sophistication from the investors that they just didn't really know what they were in, and they wouldn't be able to figure it out even if they tried.
It's not that much lack of sophistication. I mean, I've had clients who are, federal agents who investigate fraud for a living, and they fell for one. I've had, clients, the majority of our clients, or of my clients, are professionals. I have clients who are lawyers, accountants, and, they invest in something that turns out fraudulent. And they call them conmen for a reason, right? It stands for confidence. These are people who, project a lot of confidence, and they have a story that adds up at first sight, and sometimes adds up even after, a reasonable search or check. The problem with opaqueness, and I agree with you, that's something that's concerning from the very beginning, is that for every Bernie Madoff, right, who's opaque because he has something to hide, there might be some hedge fund manager who's got a great idea, and he's doing great, he's making a lot of money, and he doesn't want to, publish his ideas or tell others how he's making that money because he wants to keep it to himself or herself. Yeah. And investors invest and they make a lot of money and everything's nice. And so the problem being that you find this lack of transparency, not just in fraudulent programs, but also in many legit programs, which makes it harder to distinguish between them. You know, I'm a big fan of due diligence, and you can never do enough due diligence. I see investors, you know, people will go to 3-4 car dealerships to buy a car, spend $40,000-$50,000 on a car and then do a lot of homework online and negotiate with a bunch of salesmen, but they will not do the same before putting in $500,000 of their life savings. And so I always want to see more due diligence. Due diligence is to the bad guy, not the bad guy, because you don't know if he's, that's the whole point, right? To find out whether or not he or she is a bad person. But due diligence is to the promoter, due diligence is to the program, you know, conflicts of interest, intra-company transfers, right? Do they have 3-4 businesses and they move money between them? Well, how do you know where your money is going to end up? Exactly. You know, programs vetted by other third parties, auditors, lawyers, you know, other professionals, companies that check, for instance, for hedge funds, right? Companies that check their performance. So these are things that I'd like to see investors do more at the outset before they put their money in.
Yeah, I agree. I mean, it's once again having a process, and this is what we spend a lot of time talking about. It's like it's not just the things that we do on the Verivest side, but for me, it's more about helping investors, you know, create a process so that they follow it. You know, this is their due diligence process, and because that way, you know, at least you're marching through it consistently, and it also helps you not. It helps you stay more in the analytical side, because ultimately we're all buyers emotionally, and that thing is very, very powerful, right? And so that's the issue, is that some of these people are very, very charismatic, very, very good marketers, and you know, one of my favorite books is Influence by Robert Cialdini. You know, and he calls it like the click where bang or something, you know, like you press these persuasion principles. We're human beings. We're just wired to sort of like fall for certain things, you know, so you really have to try to follow, you know, that due diligence process and just be thorough. Like you said, you can never do enough and you won't touch on everything, but so I just believe it's you're looking for these red flags. That's why I like, you know, background checks. It just, it gives you insight into, are there any red flags there? Now, some guys, they just haven't been caught yet. So it's not the be all end all. Even a due diligence report from a third party provider, they're vetting something that hasn't yet happened, right? Like they're looking at the legal doc.
Minority report. Yeah.
Yeah, exactly. Great. You got this DD report from FactRight or Buttonwood or Mick Law or whatever. Like that's fine. Like I'm not against it. But to me, it's just one other thing. You know, the fun really begins is when you wire the money into the thing, right? And now, like you said, now that money's going to go someplace. And the thing I found as we've done the Verivest thing, that people have a hard time. They're like, Lance, why do I have to engage you guys to monitor and oversee the whole totality of our, you know, investments? Right? Like, why do I have to do that in order to attain the highest status? And my response is because if you come up with a new scheme and we're going to monitor just that one area, you could literally be defrauding everybody else, right? Like, because that's how it works. Like you said, is the intercompany transfers is where a lot of this stuff kind of goes down, right? The money goes into the place it's supposed to go in, and it goes out and goes to place it's not supposed to go. Right. And now all of a sudden you can't see it. And it also seems one of the things that people do, and you correct me if I'm wrong, but like they just add unnecessary complexity to it. So they make the thing as complicated as humanly possible so that, you know, people can't figure out what they've got, you know, but it's got some good story about some amazing, ridiculous return.
Yeah, in complexity itself, when it's fully understood, that itself becomes a risk factor, basically. When you have unnecessary complexity, that itself becomes a risk. That an investor should take into account before investing. One other thing with these intracompany transfers is that they oftentimes make it harder for the financial infrastructure, banks, custodians, to realize what's going on with the scheme.
Yeah.
And so if you have one company, say a ponzi scheme, right, and there's one company, one account, one bank, money coming in, money going out to other investors or to the fraudster, it's pretty easy these days for a bank to catch that because they have the systems in place to monitor things. So they see money in, money out. Some piece of software that the bank has is going to flag that. Now, compare that to a scenario where there's money coming into this one entity that has an account at Bank A. From there, it goes to another entity or 2 or 3 other entities owned by the same guy who have accounts at banks B, C, and D. And from there, it might go to some other account, and from there, it goes to investors. Well, who's going to see the whole picture? Nobody.
Yeah.
Because again, of the way the money is spread out across different entities. So it makes it, when you see a structure like this, it makes it easier for a fraudster to stay below the radar screen of the regulators.
Yeah. Yeah, and that's the other thing I was having. I was at a conference last week, and I was chatting with one of the guys who heads up the audit for a sizable audit firm, and he was basically saying, "I love what you guys are doing at Verivest," and he sort of echoed. And he said, "Listen, Lance, we have to turn away when people that have, smaller deals, we're turning them away. Like the amount of compliance and things we have to do to conduct an audit, and therefore the cost of said audit, it doesn't even work anymore, right? So like and a lot of that fraud is being done, right? It's in that lower level. It's all the unregulated sort of stuff, right? And so it just, even because a lot of people, they put false confidence even in, well, it's got an audit or whatever. But you have to understand, like a lot of these things, auditors won't even take the work on anymore. Like they won't even they're like, they've got so much stuff they have to deal with, and the costs are so high that you just see more and more things that aren't being audited. And then even the SEC, I mean, they've got finite resources, so the state regulators. I mean, these are underfunded entities. So the vast majority of the activity is happening in what amounts to nearly a completely unregulated space. Would you agree with that?
Yeah, I mean, these agencies are not designed to monitor each and every private securities offering, and so by nature they part of their, if you wish, part of their regulatory functions are outsourced to private actors, maybe lawyers like us who get a call from an investor and start investigating. But yeah, I mean, the regulators are not set up or designed, or they don't have a budget that would allow them to monitor and investigate every company that puts out a private securities offering.
So with all that said, as we sort of wrap up here, I mean, what is your advice to investors? I mean, you've shared some of it, just like you can never do too much due diligence, but maybe some other things just for you, just having these things cross your desk all the time. Is there any other sort of like nugget or words of wisdom that you can share with investors that just something that maybe, it's sort of that common theme of things that maybe others who have become victims of overlooked?
Yeah, I think so. On one hand, use your brain, not your heart or guts or what other body organs when investing. Use your brain. Go through a checklist, make a checklist of things to check, and then go through that. And if some of them don't check, then there's always some other investment. Use your common sense. Things like, if it's too good to be true, it probably is. That's a great investing principle. Another one, there's rarely or never such thing as the last day or the deadline in sales. Pressure selling, that's a huge red flag. When somebody gives you a deal that ends today or tomorrow, and if you don't invest, you're left out. It's the fear of missing out. Yep. Complexity, investment products or programs that you don't understand. Something that's really new and wow, we can make a lot of money and other people are getting rich. well, if you worked 20 or 30 years to save that money, you might want to spend a few weeks before you give it to somebody, especially when it's a new or untested product or idea or investment program. And so a lot of it, I think, is common sense and going through a list of things to check. And don't follow your heart, don't follow your gut, just follow your mind.
Yeah, no, it's good. I mean, it's funny, like when things, it comes down, it's simple. It is. And that's, I think too, it's like, whatever common sense you have, you use it. And if you were blessed with a lot of it, your risk probably is higher, because it might be the thing that you'll venture down into that. Yeah. But it's like, if things don't make sense to you, then you just got to stick with what makes sense. Right. And that curiosity, don't lose the curiosity to ask questions, right? Don't let yourself feel stupid or ashamed, or someone make you feel like, like that. That's the other thing, is that like, I've always been like a self-assured guy. So like, I don't care if my question sounds stupid, right? Like, I don't, it doesn't bother me. Like, I don't know, this is what came, this is the thought I had. It's an unknown. I'd like to make it a known. You may have the information I need. I'm going to ask it. If it's a dumb question, who cares? But a lot of people, it's the pride too that gets in their way of just like, I'm an attorney. I'm a whatever. Like, I should know these. I'm an accountant. I should know better. Like, I ought to know this. It's like, it's okay to not know. And so just really thinking of it that way. And if you do those things, the chances of you sort of getting burned, should go way, 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 way down. In my opinion. So, the other thing I was going to ask you, what, like, for those that when you are engaged, I mean, what is sort of the recovery rate? That was the question I want to ask you. Like, what is it, just like a super wide spectrum, or do you sort of see that there's sort of like, hey, by the time they get to you, they're going to be lucky if they get half? What's the?
Yeah, it's really broad and it's case specific, and it could be single digits, or it could go to 100%. It's really case specific. It's kind of hard to put a. Yeah,
so it is. It's all over the board. Yeah. So
and of course, past performance, right? Not indicative of future results, but it's so fact specific and case specific, and oftentimes even within the same product, you have an investor who's more like a Warren Buffett and another one who's more like a Jimmy Buffett. They might recover different amounts on the same, on the same bad product or same bad company.
Yeah, very good. Well, cool. This has been really fun having you on. We could probably talk about this all day long. I really appreciate you taking the time. Where can people learn more about you? So if someone who is listening to this feels like they may be a victim of a Ponzi scheme or some sort of fraudulent investment program, how do they learn more about it? How can they reach out to you?
I appreciate the question. We have a website that's called investorlawyers.org. So org is the extension, investorlawyers.org. And if somebody goes there, they'll find a lot more info on us and our practice.
Very good. Thank you so much, Alan.
Thank you.
I really appreciate it. You have a good day.
You too. Thanks.